What's the difference in a deal if you put 5, 10, or 20% down to buy a business? Now, typically almost every business we buy with just 5% down. A lot of people think that's crazy and not enough skin in the game, or say all kinds of things, or that's incredibly risky. Of course, think it's risky, but we don't think putting significantly bigger down payments really makes it that much less risky. And I don't think it lowers the risk enough putting a bigger down payment to justify giving up more cash up front, because businesses get in trouble because they run out of liquidity, they run out of cash. So I think in some ways you're making the business riskier by making a bigger down payment. So I'm just gonna grab the last deal we worked on, doesn't matter what it is, show you what it looks like with 5, 10, and 20%. Now this business had $4.4 million of revenue, and we confirmed about $840,000 in annual cash flow. Now making a 5% down payment, our loan payments are gonna work out to be about 13% of that revenue, which is a big number. But if we were to double that and put 10% down, now our loan payment falls a whopping 1% to 12% of revenue. And if we were to double that down payment again and take it to 20% down, now that loan payment, it's 10.5% of revenue. And if you really break into it, you actually have, interesting aspect is that you get to deduct the interest. So as you make a bigger down payment, your taxes paid go up. So really you get even less of a benefit. Now on this deal, 5% of the total project was about $191,000. 10% is gonna be $382,000, and 20% is $763,000. So putting that extra $572,000 of down payment only reduces my payments by about 2.5 percentage points of revenue, which is not nothing. It does increase our take-home cash flow by about $75,000 per year, but it reduces liquidity by a lot. And again, companies go bankrupt when they run out of liquidity, not because they have too much debt. There's a stereotype that putting less down makes it a more risky deal, when in fact, leaving yourself with less liquidity makes it a more risky deal. And don't get me wrong, we want to pay down the debt quickly. So once we have the business and we own it, and we've run it for a little while and we have a good feel, you can always start making extra debt payments. You only typically have to pay the prepayment penalty on the SBA loan if you're making extremely large pay downs, if you're paying it off all the way or near all the way. You can still make excess payments on that loan and accelerate the pay down. And we'd much rather make that decision after the acquisition. Now there is, of course, one negative. You're gonna pay a bigger SBA guarantee fee that's a part of the loan. But again, we think that's worth it because it lowers your risk having more cash. You can always aggressively pay the loan down once you have your feet under you. So if you wanna learn how to buy with 5% down, or if you have great industry knowledge and wanna partner with us to buy a business, or you just need help getting a 5% down loan, check out the link in our bio and we're here to help.